Bull call spreads, when to use, and how to calculate webinar. For anyone who missed our previous webinars, give us a call at 800-519-9085 and we can send the videos you missed. If you are a guest but not yet part of the beta program, please schedule an evaluation of your current trading knowledge so that we can prepare a lesson plan based on your level, at your pace, and on your schedule. First things first, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read all disclosures before investing. All of the examples discussed are for educational and illustrational purposes only. This is not individualized trading advice, as each person must select trades ultimately based on their own risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, please type them into the chat box and we will do our best to answer them. Also on the line today is our presenter, Mr. Adrian Mueller. He's the founder and principal of Time Leverage Capital, who was the chief strategist of Dow Jones Megatrends and All Markets newsletter, and he is the lead developer of the Option Ranger software. Mr. Mueller?
Thank you for the introduction, Roy, and very happy Tuesday to everybody. I'm very pleased to move forward to our next stage of our option series. Today we'll be talking about bull call spreads. Please be sure to read all the disclosures so you understand the program and what's available. Also be sure to get yourself set up with your own username and password so that you can log into the site and experiment on your own. Bear in mind that when you go to the site, if you haven't gone through all the programs, you have reference materials. You'll find option sheets that will give you further definitions on options and instruments. You will have demo videos which will show you how to input trades using the software and how to use the various features and help menus and pop-up dialog boxes that help you through the process. And then, of course, you can always check on margins in the event that you are doing margin trades. Please bear in mind that the Option Ranger software that is in use right now is a licensed software that has a variety of features. It covers basic stock strategies, stock option strategies, futures and futures option strategies, as well as in a master calculator for the more advanced traders, an all-in-one master calculator for all markets. Again, if you have not gone through some of the basics and you are picking up over here, do not hesitate to go to the reference materials or to ask us for links to the various demo videos. The demo video section is being beefed up as we speak, and this program as well is going to be available subsequently for discussion on the markets. So before any further ado, let's go ahead and proceed with looking at the bull call spreads, and let's begin that by finding the scenario under which a person would consider doing a bull call spread. As you can see, and this is our strategy gallery under which you have all the various trades and scenarios listed. This is where we're going to find all scenarios and the various strategies that are believed to correspond to those scenarios. As you will notice here, today we are looking, there are two bases on which to decide the trade. One is direction, an opinion that you have or that you have adopted from a third party that you like, maybe an analyst or a newsletter, on whether the market is bullish, going up, bearish, going down, or undecided. You think it's just going to flounder sideways, or perhaps you're undecided because you don't know whether it's going up or down. For all of those directional scenarios, that is one input that you should think about when you decide on a trade. And most people are very mindful of direction, thinking, are things going up or down? And that's pretty much, unfortunately, where most people's thinking stops. The second and extremely important ingredient in selecting trades and selecting strategies is volatility. Volatility basically is a measure of how much the market is, how widely it bounces, how much fear is in the market, is there a panic premium in the market, and then you can forecast along with the direction whether you think the market is going to get more volatile or more crazy, if you will, or less volatile, less crazy, if you will, which is volatility falling. And finally, just as on undecided, if you really think a market is going to go sideways or you're not really sure about what the volatility is going to be. As you can see, the bull-call spread that we are doing today combines the following. It combines a bullish direction, so it's a person thinking that the market's going up, with a certain level of uncertainty as to whether the volatility in the market is going to go up or going to go down. So it's a bullish trade with an uncertain outlook on the volatility. When you look at these trades, again, when you go into our strategy gallery, you can always click on the individual trade. Allow me to do that right now. And when you click on that trade, you are going to be taken to a graph so that you can have a visual of the trade and the components of the trade. I want you to know that the software is designed to take this rather obscure-looking chart, which these types of charts have been around for years from the exchanges and other sources. And what we've done with this calculator is taken this rather obscure chart, which does give you the composition of the trade accurately, no doubt, and try to put numbers to it so that people can see real numbers and real spreadsheets to make the trade and the risk and the potential reward of it more clear. So let's talk about the trade. As we indicated before, it's a directional trade. In order to put on a bull call spread, you have to have a sense of direction, and in this case, as we saw, you have to have a sense of bullish direction. Now again, you can also establish this trade for a number of other reasons. For example, maybe purchasing a call is very expensive in a certain scenario and you want to reduce your cost by selling another call. The trade-off is you are capping your profit potential on a very large move, but you are also reducing your initial cost and your maximum risk if the trade does not go in your favor. As I indicated, the profit potential is limited to the difference between the two strike prices, the long call strike and the short call strike. The long call is the option that you buy. The short call is the option that you write. If you need to understand these individual components prior to looking at this trade, you can go back to our gallery or look at our individual demos on long calls and short calls, which we've already completed. Nonetheless, even if you haven't done that, the Option Ranger calculator will still output the risk and reward numbers, and you will be able to see whether or not a trade is worth your while based on your opinion, strictly on the numbers basis. Our recommendation always is that you also learn the individual pieces of the trades and the component. It's a little more homework, but it gives you a better understanding of the trade and how it ties into your expectations. Finally, when we look at the trade details, as you can see here, the bull call spread is used when you think the price of the underlying commodity will rise moderately within a certain period of time. It is in the near term, and we've discussed the structure. It's buying a call and selling another call at a higher price. And as we indicated before, the money that you collect for what is hopefully an out-of-the-money long shot is intended to subsidize, based on your volatility outlook, the purchase of an option that is closer to the money or perhaps at or in the money. Again, for that terminology, be sure to go to our reference materials and our FAQ guide. So again, we are looking at a trade for a moderate rise in prices, not an explosive rise in prices, and specifically we are looking to reduce our cost by selling an out-of-the-money call that we do not believe is likely to become intrinsic. This is a spread, and by the way, this can be a spread in stocks. You can do a bull call spread on stocks. by purchasing a call and selling shorting a call farther out of the money. The risk components are the same. The erosion components are the same. Today's examples that we have set up by request of some of our attendees are going to be on the commodity markets. So we're going to go ahead and discuss a bull call spread, in this case on 3 different commodities. However, one of those trades is going to be on a stock index. So I think that's going to show some correlations to equities, and of course you can do these calculations on any equity you like. Bear in mind, again, I just want to show you that the beginning of all trading in the option ranger starts with a very simple page. You have our logo, which tells the picture. We are not trying to do a bullseye. It's in red. The bullseye is very difficult. Well, we are looking for a range. We are looking for an area of profitability that falls within the broader parameters of what you believe or what we believe, rather than trying to be extraordinarily precise. So in this case, we're looking for direction. We're not so precise. And intuitively, from these few inputs that you see here, all the dialogues and all the help boxes can take you through to some of the most advanced trades and spread trades, all of them intuitively displayed so we can do the math. So let's go now, without any further ado, to our futures spread calculator, where we have our saved trades for today's demonstration. And then if you'd like, we can input some trades so you see how it works. We have here under custom tabs 3 markets on that scenario. We have a bull call in the S&P for June, which is, as we indicate, all bull call 1 by 1. These are 1 by 1 spreads, so they involve no margin. As long as you do a bull call spread and you have 1 call, 1 long call for every short call, your risk is limited and predetermined. So now, as you can see, we've clicked on the trade and we have the S&P 500 index, which trades at 250 times the S&P 500 trading price. So this is a significant and powerful contract. You are leveraging a contract that is 250 times, call it 1838. So you are leveraging a very large contract, and in this particular case, that's where you want to consider looking at a bull spread with relatively little outlay. So let's look at the composition of the trade. We're looking at a call spread, which is 1 by 1. The strike price is selected, and this is, as you can see, for the month of June. These are June options. And these are approximate prices. I'm not sure when they were taken, but they're for illustration purposes. We're looking at purchasing an 1820 call for a premium of 63. And as you can see here, when you input this trade, if you're in the middle of inputting, this strike price example will come up and show you how to input the trade. If you want further examples on strike prices, as you can see in these dialog boxes, you have additional help menus that emerge that you can go to as needed intuitively from the one page. For those of us that have already done this, I'm going to proceed now and click on premium. And as you can see, when you input the premium, an example of how to input the premium also shows up. And if you're not sure what the premium is or how it works, again, there's an immediate reference so that you can redefine it on the fly as part of your learning process. When you input trades, whether you can input them directly or whether you need to go to the help dialog box or further inside the dialog box, it doesn't matter. As long as at the end you know how to go and do your own calculations. We find that with experience, people need to click on these other selections less and less. As a point of information, I do want to indicate that when you click on Complete Contract Specs, you do go, and I will show you as an example in the Option Ranger, for example, and I have saved here in the corn market, you go to a page that has all of the various contract specs on the market, a short-term chart, as well as some links and reminders of what needs to be considered prior to entering a trade, so it's what to watch, and also what you need to follow while you're in the trade. So this way you're just one click away from being able to go to some of the primary sources, and as well as other things that you can follow either through our website or independently as you wish. And again, one of the indicators that you can look at, and I find it important, for example, if you look at a trade, you link there, you go to the next thing, you can be taken straight to a primary source, the Commitment of Traders report, and so on. So as you can see, you can start very intuitively from this program and go literally link by link into more detail as you need, and then go back to your original trade. So now we're looking at a bullish scenario.
We have a question. We have a question
Yes.
regarding a call spread. Should the
Okay.
call you buy be in the money?
That's a very good question. It depends on your outlook. The call that you buy, the more, if you want to buy a high quality position, and the price of the in-the-money call, and in this particular case, this is an in-the-money call. It's actually, where's presently the futures price that we're looking at the June month?
That was June Gold.
This is June S&P.
Oh, the June S&P, I'm sorry. It's at 1838.
Okay, so it's at 1838, and this is an 1820 call, so it's 18 points in the money. As remember again, if you have any questions on in the money, at the money definitions, go to our reference materials and you can look up option sheets that defines in the money if you don't know what that means. In response to the questioner, buying this option in the money, if it's 63 points and it's 18 points in the money, it means that the volatility value or juice in the option that you pay in anticipation of an increase, and also to mitigate your risk on a drop, the volatility or time premium would be 63 minus 18, which would be 45. On the other hand, to make that point, the option that you sell out of the money at 1920, which is quite a ways away, you're collecting 17. That entire premium that is collected is speculative value. In other words, if the market doesn't get there, that option will erode to zero, and it reduces how much you spend on this. If you are looking for, which is the objective of a bull spread, if you are looking for a trending move, not an explosive upside move, then I would say buying an in-the-money option, if it's within your budget, will yield you better results on a smaller move. And you're going to see that because we're going to do a couple of comparisons in a minute, because we're going to show the same trade buying out of the money option and see which will work better on what size move. That's really the purpose of the option ranger, because we can take that question of which option to buy and which option to write away from pure speculation. And of course it is speculation. We're speculating on a market making a certain move, but we'll be able to mathematically measure based on intrinsic value at expiration or any time on intrinsic value, when does that trade make money, where does it need to go in order to become profitable, and likewise with a premium. If you think that a move is going to be fairly good size move or nothing, then you might look at these again and say I'm willing to buy an at or out of the money option and then sell an out of the money option. And again, that would call for a different scenario and a different expected move. And that's with the option ranger. We can go through those very quickly, and let's see what happens here. Okay, we're looking at a trade here, which is, again, so let's analyze this, and we'll compare it with an out-of-the-money option and with an at-the-money option. Thanks for the question. First of all, we have the composition of the trade in the strategy box, which tells us this is a debit. We paid $15,750, hypothetically, of course, according to this scenario, collected $4,250. So the net outlay, and this is not a cheapy trade, is $11,500 on the spread. So this is a trade that should be monitored closely because there is a fair amount invested in it, and you would be very mindful of not having a trade like this erode altogether to zero. Then we input transaction costs because you always have to factor in the cost of doing business. In this particular case, we're factoring in 55 a round turn as a default number, and then the net debit on the trade is 11,610. Now let's see how this trade works. The low break-even point on the futures, meaning that the futures will, your position will break even intrinsically if futures get to 1866.44. Markets around 1838. So you need quite a move to become intrinsic on this trade, and you have to be very mindful that if the market doesn't rally fairly strongly, you have to be mindful of that premium. Your break-even on premium, which is the ongoing calculation of the difference between the call and the put in this case, is 46.44. So whether you're looking at intrinsic value on the contract or whether you're looking at the actual premium quotes at any given time, you can analyze and look at the break-even in both ways. And a serious person who wants to watch their money is going to track the premium as well as the intrinsic value on the contract or the value of the contract in the course of monitoring the trade. While the cost of the trade is in this case 11,610, you would think of it as being pretty steep. One of the reasons for that cost is because, as you can see, your maximum profit is limited, but so is your risk. So you stand to lose no more than the premium paid, which is one of the attractive features of a bull call spread or a non-margin trade. And again, remember, for purposes of reference on the tab, we do label this trade as a no-margin trade so that you can see the difference. So there is a trade-off. You're spending some money, but you are predetermining your risk. So should the market drop precipitously, if the S&P falls out of bed and you were wrong and you were bullish, if you sit on your hands and you don't salvage any premium, the most you can lose is the premium and costs, the total cost of the transaction. I would say that if anybody sits on their hands from now through this expiration in June and the trade doesn't go their way, I would suggest alerts, various levels to look at stopping out of this position, maybe when it's at a 30% or a 25% or a 40% loss. Again, stops are market orders, so they don't necessarily guarantee a fill, but you shouldn't just sit on your hands and let this trade go. On the other hand, on the upside, if the market does go ahead and make a move, you start getting profitable, as we indicated intrinsically, at 1866.44. So if you really have an expectation that this market is going to find its way anywhere above that level, you start making some real money, 1880, 1890, 1900, and so on. And as you can see, the gains get pretty good until they get capped out at 12,390, which is the difference between the two strike prices minus the cost of the trade. As you look at this, there's one thing to keep in mind. Where does a person do such a trade? Where does one really contemplate on spending this kind of money on doing a trade? Well, I'll give you a very simple example as a hedge standpoint. If the index is currently, let's say, at 1840, to make the last math simple, it's around 1839, and a person says, you know what, I've got $460,000 in the stock market, and I'm really scared that the stock market's going to tank, and I'm going to take a major beating. It could go down 20%. I could lose over $90,000 on a 20% drop, and I've got $460,000 in the stock market. I use that number, by the way, because I'm multiplying the current S&P value, which is 250, times 1840, which is the S&P index price, which brings us to 460,000. So now what you're realizing is this is a lot of leverage. So if a person says, you know, I've got $460,000 in the market, I'm going to get out. Or I have $1 million in the market, I'm going to take out $460,000 because the market's high. But that same person is going to say, well, I'm going, on the other hand, if the market goes up a lot, it gets to 1900, I'm going to shoot myself. And it's an exaggerated reaction, I agree, but some people get pretty emotional about money. And frankly, those are the people who should know what they're doing, because it's one thing to lose money if the markets are against you. It's another to lose money out of plain ignorance. So in a case like this, somebody who thinks, I think either market's going to tank and take a horrible beating, or there's a greater risk of a horrible beating for somebody based on their personal finances or personal situations. Say, I can't take a 20% loss. I'm taking money off the table. But nonetheless, if that person says, you know what, if the market goes to 1900, 1920, any of those numbers, I don't want to kick myself because of all the gains that I missed. So in a scenario like that, a person can take some of that money that they took off the table, specifically 11,610, and say, you know what, I'm not going to risk 460. I'm not going to risk losing 90,000 or more on a 20% or bigger drop. But I'm going to put about 11 back in the market, 11.6 in the market, and if the market runs, at least I'm going to make something on these bull spreads. If it drops hard, I only reinvested a portion of my cash, and then it's just a mental game of where to offset the long premium to minimize your losses. So when you look at it from that point of view, again, from a broader portfolio perspective, this trade might make sense, not just as a bullish, no volatility expectation trade, but also as a way of replacing synthetically a stock position that carries a larger risk in the aggregate with an alternative position that in total carries less risk and still has the potential to benefit, so that what you don't miss out on the stocks that you offset, you have an opportunity to gain over here. And again, on 400,000, if the market goes up 10%, argue 460,000. If the market goes up 10%, you get 46,000. In this particular scenario, you get less, but you're also risking significantly less. And again, you are less susceptible to that major drop. For people that are not working against the stock portfolio or against offsets, this scenario then would become strictly a speculative trade looking for an upside. What I want to show you very quickly, and it's really one of the features of the Option Ranger, is that if somebody was thinking, well, you know what, I think the market might go up some, and it's not a hedge scenario, but they say, well, look, I'm going to go ahead and sell a couple of calls to make this trade cheaper. And all you have to do is change one field. So you go from selling one call to two calls. Everything else stays the same. Now this becomes a ratio spread, and it becomes a margin trade. So I'm not going to save that trade under the no margin tab because it's not a no margin trade. And it'll show you how selling an extra call now does make it a margin trade. Whether or not that's suitable for you or in line with your opinion is a conversation that you have to have with yourself and somebody who knows your finances better. But here it goes. By selling two, all of a sudden, as you can see, your cost went down because you're selling two at 17. So now instead of collecting $42.50, you're collecting $8,500. You still subtract your transaction costs, of course, but now your outlay is $74.15 instead of what we previously had, which was, and this is where it's good if you don't have a perfect memory, to just be able to click back and forth between trades. So here we go to a scenario where on the 1-by-1, you see that your outlay was $11,610, including commissions. So you can go right back and forth between trades. So we click on this one here, then we can compare it right away to the 1-by-2 and see that our outlay is much less now, significantly less. It's only $74.15. Our premium break-even on premium is lower, again, because of the lower cost. Our futures break-even now is also lower. In fact, it's very close to the market. It's only 9.5 points or so away from the market. And however, now you have a high break-even point and high break-even premium point because you sold an extra option. As you can see here, and in case anybody forgets, this is what the software does. It shows you a new sweet spot, a new range where that trade works, but there's a point at which the second naked option starts going against you. It's not a non-margin trade anymore. And if anybody fears in putting together a trade like this, that the market might find its way above, holy cow, 1990.34, call it 1990, such a person would not sell that second option. For a person who's looking for a moderate rally and is willing to take a margin risk on this, on a breakout above 1990, then their sweet spot moves lower. Their profitability at numbers like 1920, 1910, all these numbers improves. And of course, if the rally is explosive to the upside, then they are running into some margin risk over here. So that would be something to reconsider. Now, I'm not going to save this trade under the no tab margin. And if you were to look at it on your own thing and you didn't want to get tempted by a trade like this when you saw it was a margin trade, you can just go ahead and erase it, or you can save it under a new tab. And let's see where you can create a new tab for this in this section, and just make sure that you label it as a margin trade so that you don't get confused. To avoid confusion during this session, now that I've showed you the example and the difference about writing an extra call for margin, I think the trade doesn't look bad for people who can afford it. I'm going to go ahead and offset. I'm going to go ahead and exit that particular example.
We have a question regarding the features of the Option Ranger. Does it show the Greeks of each option?
We currently have the fields mapped to show the Greeks. The reason we are not using the Greeks in this version is because you have to bear in mind that anything that is other than a real number, for example, implied volatility, or the various other Greek levels, are based on human inputs that can fail. The people who designed the Black-Scholes model, which is the Nobel Prize winning team, it was pretty much those models that went into effect that blew up during the debt crisis, the Russian crisis, long-term capital. This particular program does two things. It shows the intrinsic or in-the-money value at expiration, which really as an educational tool and as a point of reality is the only objective, measurable outcome, which is how much are these things intrinsically at expiration. I think it is the #1 most important first step and objective fact, which is where are values intrinsically based on contract movement. The second measurement, which people have to monitor all the time, is the premium value, which is why we have not just the intrinsic value listed, but also the premium value listed. We are currently and have already tested successfully mapping the data to fields with all of the various Greeks and implied volatilities and everything else. We are currently not enabling those features because we think a lot of people go straight there and don't see the risk, the realistic risk on certain trades, and strictly look at volatility. So let me show you one thing that we can do here, and it may be not as people have such a predisposition and a bias in certain markets that they're going to say, oh, what do you mean the market's going to go to 2060? And this trade can lose $17,415 at that level. Well, regardless of what the outlook might be on volatilities and deltas and thetas and time erosion, all of which are important, it is important for a person first and foremost to see that these are the kinds of losses that can occur. And you can see in certain markets, I'll give you an example. I remember BSE, mad cow disease. When mad cow disease broke out and people had sold puts and did all kinds of things in that market, there were all kinds of fancy measurements of implied volatility and everything else. And I can tell you from my own sad recollection that there were very nice, very smart people, wrote naked puts in that market, based on volatilities and delta and theta. There was nothing factoring in that kind of a serious event, and unfortunately had extraordinarily dire consequences for people who were looking at all of the fancy details and failed to look at the big picture risk. The Option Ranger is an educational tool that will show people big picture risk and will be a stepping stone, assuming that people fully get this, for them to also receive a version that is going to be mapping data to the Greeks and updating quotes with an update button. And in fact, we have access for the beta users to a full simulation platform and paper trading platform to track the values and to follow the Greeks and so on. I think that for most people, it's like trying to do calculus before they can do algebra. And unfortunately, it is the simple things that hurt most people, and what, after the fact, with the benefit of hindsight, would be the obvious things. I find that people understand delta and theta and vega and the Greeks much, much better when they have a very clear grasp of these initial concepts and when they can model out some of these trades. And once they pass the test of the Option Ranger, if they want to do a more advanced assessment of which options to pick, where there is a volatility skew, then that is going to be available to them in a more advanced version. Right now we're just going through the basics that, again, we think most people are missing. Anybody who's really interested in joining the beta group, and the Greeks are included, please send your information to our development group, and we're going to make a note of your name, and probably sometime within the next, hopefully within the next 30 to 60 days, we're going to make the mapped data fields available to our beta group as well. If you, again, are actually trading in the market, then we'll get you access to the Greeks so that you can analyze the Greeks along with the P&L tables that we have right now. Okay, now let me go ahead, and if I may, both of those questions were very good. If I may, let me go back to the first question on buying different strike prices. So now let's look at an out-of-the-money option for the same time frame. Okay, let me go ahead and get rid of this trade first. And let me go back to the initial trade, just a moment, that we have under tab here. Okay, and we're going to make a change to it right now. Let's go ahead, and can I get a price on an 1850 call for the same month? Now we're going to go a little bit out of the money.
The 1850s are going for about 45.
Okay, so we're looking at 45. Now again, this is to go to the question earlier about if it's better to be in the money or not. We can actually try to get the first idea of that, the first scenario, without changing, without a significant change in our volatility discussion, and see how that trade compares to the previous trade. Well, first and foremost, as you can see, by going 20 points up in the S&P, we have significantly reduced the cost, the difference between the two strike prices, because the long option now is out of the money rather than in the money. So it's got strictly volatility value. The trade has gone significantly. So again, spending 71.10 if you factor in your costs instead of, and again we can always click back and forth to refresh our memory, between 11,610. So now for a person who is simulating, if you will, an upside move, or is anticipating an upside move on spec, or maybe replacing an element of a portfolio that has been offset for whatever reason, tax purposes, risk management, taking risk off the table, whatever the case may be, now the cost of that is less. It's still a no margin trade, as you can see. So the risk is limited to 71.10. It's no margin. Please note in the Option Ranger that we make a point of emphasizing risk, not profit. So the reddest thing you see on there is the risk line. And the profit line now, which also at this point, which is 10,390, is also there, having factored in costs. And again, we have a premium break-even, but no margin, high break-even point. Now, as we can see, if the S&P goes to zero, or doesn't do anything, or flounders around pathetically, or goes down, the maximum risk that you can incur on this trade is 71.10. Again, bear in mind that if you have this much long premium or invested premium in a position, it would be extraordinarily foolish to let all of this premium erode and actually incur the maximum risk. So what we risk here, listing here again, and it's taking out the Greeks and which give Vega, also makes this trade look worse, because the truth is, if the market gets to 1850 at expiration, yes, theoretically you lose 71.10, but chances are if it gets to 1850 tomorrow, the premium will go up because it still has a lot of time value. So the function of removing the Greeks to some extent also reasonably understates the value and the potential when salvaging premium on options. And that's perfectly fine, because we want people to get, if anything, more of a worst case scenario or a negative scenario than a positive scenario. When you look at the premiums on this trade at any time, and you know your premium break even, if somebody buys this spread and they say, you know, the spread's at 35 or at 40, you can know it costs you 28.44. You take the difference, you multiply it by 250, which is the tick value that you have on here. Not to mention that you can have the difference from our customer desk or from your online platform on which you are simulating. So that you would certainly know if you wanted to take your profits and move on, you can do that on premium. But at expiration, these would be the values, and as you can see, your break-even, because your output is less, your cost is less, your risk becomes less on a flat or down market. Your profit is also smaller on a rally. But again, on a percentage basis, you would see that on a, that this spread, if you are less willing to invest a higher sum of money and you think the market could take a run at 1880, 1890 by expiration or above, then this trade, as you can see, would be profitable beyond that level. Again, in most cases, if you monitor this trade as you go and you look at the premium, which is what you need to look at all the time, in all likelihood, many people will offset this position well before expiration, and you can offset before expiration. These are liquid markets. You see a bid and ask, you call your broker, you go to your platform, and you don't have to be in this trade just because it's June options. If this trade goes your way in 5 days and 10 days, whatever the case may be, you check it, you monitor it, you're responsible with your money, you set alerts, and you decide whether to get out because you're in profits, and also to get out, let's say if this trade is not going your way, things are quiet, you spend 71.10, your position is down to 5,000 or some other such number. There's nothing wrong with salvaging premium, reducing your losses as much as possible, because one of my favorite sayings, and one of the ones that I find to be accurate in the markets, is, "He who fights and runs away lives to fight another day." So you need to value your money. This is not a dice game. You don't leave it on the table. You do your calculations. If you're wrong, you cut your losses. It's not an ego thing. And if you make sufficient profits early on the basis of premium, there's nothing wrong with taking that premium and not waiting for the intrinsic value to pan out. So now let's take another example, and let me just go ahead and show it again for purposes of illustration. And you can see when we add these trades, they're being added to the current trade tab, so you can keep comparing these one against the other. Let's just do one more, and let's do an 1870. Now this is already an out-of-the-money option against the 1920. You're left with a 50-point spread. And how much is the 1870? Well, I'm not recommending this trade. We're just doing it so people can see the difference between an in-the-money option and a couple of an out-of-the-money option, and then a farther out-of-the-money option. How much is the 1870, please?
You could purchase it right now for 35 points.
Okay, so let's call it 35 based on current prices. You're selling at 17. And let's go. By the way, if you look at a trade like this and you want to get a friend's opinion, you can email that trade to a friend. You can print it out so you can write on it and scribble on it or put it to a chart, and also you can save this trade under a tab later on. And again, we already have a tab for non-margin S&P bull call trade. So let's say if we wanted to, I'm not saying it's a great trade, but just for purposes of illustration, you can go ahead and save that under a tab. We're going to save it under that tab, and you will see in a moment that now we have that trade is already listed here so that you can track them both for comparison purposes. The way the brain is wired is that it's going to retain information better when you see these numbers and these break-evens and so on in black and red and the whole grid up and down in multiple combinations, one after the other. The brain is, I would say, much better wired to recognize spreadsheets, both because of the visual nature of it, that numbers are included, and also because many people are accustomed to looking at spreadsheets and making financial decisions with spreadsheets. So we're a little more wired to recognize risk and reward in the spreadsheet format than in the more commonplace and of course very popular format which we've seen, which is on the which we have in our strategy gallery. And again, bearing in mind that when you look at our strategy gallery, be sure to get your own username password so that you can get in there. I keep calling it up, and here we go. And of course, you have the Remember Me feature. You know, in the strategy gallery, when you look at these things, let me go right to the call spread. I think that if a person looks at a spreadsheet to understand the trade with real numbers, or they look at a graph like this, in all likelihood, and based on brain science and just based on what we're looking at, we're less accustomed, although we can understand this graph, and it's an effective graph from a reputable source, although we can see this and perhaps understand it, there is no comparison between that and being able to look at actual numbers on a grid that we are accustomed to looking at much more. So let me just go ahead and go back to our calculator just a moment. Here we go. Alrighty, and here we are. And then we are seeing, again, as you can see, these trades have already been added. So let's go ahead and have a look at the 1850-1920 spread here, which we've already done just a moment. And let's look at the, let's add the 1870 now. At 35. And you see, you don't have to change the whole trade. You can experiment with new values and so on just by doing that. Let's hit calculate. And let's see how now it's really much less money. Of course, we're buying out of the money and selling out of the money, so there's no intrinsic value. But this trade now is 4,500. Call it 4610 with a default trade. So no matter what happens in the market, the most you can lose is 4610. On the other hand, based on your break-evens, you can have your break-evens again here, break-even on premium, 18.44. So your break-even on premium is lower, but chances are you're probably going to need a larger move to the upside because your long option is out of the money. And again, you'll look at the profit and loss scenario. This really picks up, and your objective, your sweet spot really on this trade is at 1920. Anything above there, you're still capped at 78.90. So this, again, is a bull spread that, from my point of view as a speculative trade, would take all kinds of special explanations, and in all likelihood, I would not believe in doing this kind of a trade unless I thought that the market was going up. It's going to go up fairly steadily with a reasonably low level of volatility and find its way into that sweet spot. But again, I think it's a very narrow sweet spot, and for my analysis on the calculator, although this trade may make money, it may not be the most attractive way to do the trade. So whether or not you save it under the tab, that's an option. Now let's look very quickly at a couple more markets. I'm sorry, I tried to answer the in the money, at the money, out of the money long call option. Let's look very quickly at a soybean trade, and this was input earlier. There's a lot of excitement around the soybean market. Somebody asked us to do an example earlier because they saw the article on both the Commitment of Traders report that we showed earlier and also on the dryness in South America and some of the concerns. So we were asked to show a bull call spread. We're talking about a weather markets and all kinds of unfulfilled conditions. So we're going to show a call spread but not necessarily recommend it while doing so. So let me go ahead now and click on the soybean trade. As you can see, immediately all the fields are populated. The inputs, the strike examples, the premium examples, and the link to where you find all your information now have also changed so that all your dialog boxes are already in place. And here we're looking at a trade again. In this case, it's 1800, which is buying a call for 56 cents, selling one for 20. And as you've seen, we do explain the contract specs up here so that you know we're talking about a 5,000 bushel contract and the tick value on the movement, and then you can go view those contract specs here. Pardon?
No, please continue.
Okay, let me go ahead now and show you that on this particular trade, again, it's a non-margin trade. We labeled it, but some people just don't want to do margin trades, and I think they should be aware, and other people are willing to do margin trades. That's fine, but you should have a way of understanding for yourself and determining for yourself what's suitable and what isn't based on your own finances. If you're not really sure what's suitable for you, you should talk to somebody who's qualified to discuss that with you so that you can make the right determination about your own situation. We're not doing that. Right now, this is a modeling and educational exercise. As you can see here, the maximum loss, again, this is one of the reasons to spend the money and to pay the premium on the bull call is that your risk is limited. Again, highlighted here as a maximum risk of 1910 if no offset occurs before expiration and the market is below your long call. The profitability begins, and let's look at it on premium because you're always tracking premium. You would want a premium to be, your premium to be above 38.2, and you would want at expiration or intrinsically the futures to be above 1358. So you have a quick reference box here. Where's the premium? If you get a quote on the premium, you'll know immediately if you're up or down in the trade at that moment. And you also can look at the futures price and see intrinsically if you are heading in the right direction in terms of your time frame towards expiration. I believe a serious person will track both and be mindful of both numbers in making their decisions. Finally, a key on a trade like this, because you've invested money in premium, is if the market does not rally in your direction, you have to look at strategies to mitigate or reduce your losses by constantly getting premium quotes and deciding when and where you are prepared to change your position on the trade like this. And as I said before, he who fights and runs away lives to fight another day. You can move on from this trade if it doesn't go your way. On the other hand, we are looking at some numbers that do not appear so extreme, certainly with the types of movements we've seen recently in weather conditions. We are seeing the sweet spot for this trade, which is a bull spread, as being at 1420, at 1420 basis July, and here we have a market that's at 1330, and I can tell you it's gotten there pretty fast. We're up 22 3/4 cents on the settlement today, so we are also seeing some rising volatility in these options. Okay, so this is the soybean trade, and again, you can play around with different strike prices and different values for people that can afford margin, and again, we're not going there today. They can perhaps sell more calls so that their sweet spot changes significantly. And again, if you do so, and this is not part of today's seminar, just an illustration, it's very easy to do that calculation. You do a 1/3 ratio. If you think the market's going to run but not go crazy, not get above 1465, 1466, let me see, whatever your break even is. Now you've got an outlay of only $20. The market can tank through the floor. So you can handle a drop in salvage premium. On the other hand, because the layout was so small, the profit zone is pretty early. It starts from 13, as you can see, already making pretty decent money at 13.30. And if the market moves up strong and you're beginning to exceed the 14.64 level intrinsically, then you do have naked margin. So again, the illustration is the minute you move away from a 1-by-1 ratio to an increased ratio, in this case a 1-by-3, your maximum risk changes. As you can see now, it's labeled as margin and unlimited. The loss is $25 per tick above 1469.80. And somebody thinks that this market's going to go up, but it's not going to make it much past 1430 or 1440. And you can do your own analysis then, and if you are in a position to trade that way, then perhaps this trade on that scenario might make more sense on a ratio call spread rather than a bull spread. But again, as I indicated, the option ranger will alert you, and you should be aware that once you start writing those extra call options against the long, you are beginning to take a margin risk, and that margin risk is in exchange for significantly reducing your cost, reducing the place where you become profitable, increasing your sweet spot on smaller rallies, but correspondingly also increasing your risk if the move continues to go up with rising volatility. So again, that's just to show you the difference between a call spread and a ratio call spread, the first being a non-margin trade, the second being a margin trade. And finally, people are beginning to take a look at the gold market again because it's stirred. It seems to have held support in the somewhere between the 1200 and 1250 range. So in this particular case, we're looking at an example for August gold. Fair amount of time, again, because it's a 1-by-1 ratio, there's no margin. And we are looking at a, hold on a second, let me move to this trade. I'm still looking at an old trade. No wonder the numbers look wrong. So let me go here, and here we are. We're on our gold trade. Very good, and we see that when you change the trade and you pull up a save trade, immediately all the dialog boxes with the explanations and the one click to the next help example appear. So in this particular case, we've input the trade, we've input it this way. There's an expenditure of 5,800 on the long call at 1320, which is slightly in the money. There's a sale of a 1420 call, which is $100 out of the money. So the net debits between what we paid and what we collected is 3,600. Again, you do a calculation of the costs, in this case a default of 55 a round turn, and we know that at expiration our low break-even on the futures means that sometime between now and that expiration, intrinsically you want to get above 1357.10. In terms of monitoring that trade day to day and seeing what it's worth, whether you want to keep it or whether you want to get out, your low break-even, your break-even point in this particular case is 37.1. And again, because you're leveraging 1,000 ounces, you can see why that would be 100 joint ounces. 100 times 100 times 37.1 is 3710. So that's the calculation. That's your break even. So you just have it right there to track your premium every day for break even and also to track your intrinsic value. I think people need to track both in order to decide whether to stay in a trade or whether to offset the trade. Now, what we have here then is a maximum loss. Again, it's a 1-by-1, no margin trade of 37.10, which is the total cost of the trade, which is your premium and cost, and your maximum profit is again 62.90, which is the amount of the spread minus the costs. And if you do that math, the amount of the spreads, as we have said before, is 100 times 100, so you're looking at 10,000 minus the cost, 37.10, gives you your 62.90, which is your potential profit. You don't have to do the math yourself. The calculator does it. And obviously, your sweet spot on expiration is anywhere above 1420. You know, it sounds like a big number now, but doesn't sound as big as it was when when we saw gold chasing 1800. Now again, what you want to do is salvage premium if the market is flat, and you want to watch premium if it starts to rally but not sufficiently to be deeply intrinsic. Then you can go ahead and look at strategies to offset the position. If you feel it's going to continue to trend to the upside, then approach 1400 or 1420. Looking both at premium and intrinsic value will help you decide whether you want to hold on or whether you want to move on. I think that that does it for us for now. If anybody has any further questions, please go ahead and forward them to us. Be sure to set yourself up for an intake interview so that we can set up the right curriculum. This webinar may be too elementary for some, too advanced for others, so it is better for us to communicate directly and set up a lesson plan for you based on where you are so that you can be provided with the tools and the modules that are appropriate to your current level as well as to your schedule and availability time-wise to devote to improving your knowledge about trading futures and options and stocks and stock options and so on. So you are invited to attend future events, and even more importantly, to set up your own user site with unique username and password so that you can start experimenting and using the program for yourself. I look forward to doing our program Thursday, which is the counterpart to this program, which is going to be buying bear put spreads, which are the bearish version as to volatility of the call spreads. Again, happy Tuesday to everybody, and I wish you all a lot of success in your trading and a lot of good things in your personal lives as well. I hope you got something out of it. Have a good afternoon.
Thank you.